Hey, what's going on, traders? I hope you guys are well today. This is Chris from Verillo Trading. I thought I would make this video today because it's something I've been thinking about and working on in my trading recently, and I thought it would help some other traders out there as well. So in this video, we're going to be talking about specifically the micro E-mini products that trade on the Chicago Mercantile Exchange, and if these products are good products to trade, and what I think of them after trading them for around 2 years with very small account sizes. And let's get to it, guys. So if you enjoy this content, leave a like, comment, subscribe, all that stuff, because it helps a lot with the YouTube channel and whatnot. So that's what it is. So these micro E-mini futures. Now, when traders get into futures trading, well, the first thing you learn is that you're trading leveraged products, and there's a large amount of risk and profit potential involved when trading leveraged products. And basically, look, I'm going to give you my perspective. I'm 27 years old. I'm not super rich. I don't have a whole bunch of risk capital ready to deploy into a futures trading account. I would much rather trade with an account of a few $100s to a few $1,000s if I have to, and slowly build up my consistency there before trading products that are much more risky and leveraged to trade. So I've traded the micro E-mini NASDAQ futures now for probably just about 2 years going on at this point. And well, in case you're wondering, not profitably, of course. But what I've realized recently after looking back over months worth of data is that the commission structure associated with trading these E-mini micro contracts is not very favorable if you're a scalping type of trader. So in this video, I'm going to try to explain to you, multiple scenarios and things that you might not be aware of because you didn't take the time to do this math, and I didn't take the time to do this math because clearly I'm an idiot as well. But now I did it, and that's it. Put yourself in the situation of, a relatively inexperienced or a relatively new trader. You want to trade real money, but you want to trade small. Now, the S&P futures are $12.50 every tick. So every tick it goes in your favor, you're making or losing $12.50. For the NASDAQ futures, it's even worse. For every tick it goes in your favor, you're making or losing $5. And the NASDAQ moves around 3 or 4 ticks for every tick the S&P futures move. So that's about a $20 movement in the NASDAQ futures for about a $12.50 movement in the S&P futures. So the NASDAQ is a little bit more risky, more leveraged, in fact. So when the S&P volatility is low, a lot of traders will go and start trading the NASDAQ because the risk to reward opportunities are a little bit better in that case. But if you're a small trader, you're still not going to be trading for $5 a tick in this case because that's way too much. You need about a $3,000 to a $5,000 account minimum, and you're going to be trading with day trading margins on top of that because the notional size of these products is like hundreds of thousands of dollars. So you're only able to trade using a $3,000 to $5,000 account because you have access to intraday margins. Now, we're going to get on to the thesis of this video here, which is basically this. The micros, in my opinion, are a ripoff. If you're a scalper and the CME is juicing you to eternity, they don't care about your small account, and you will become an eternally depositing trader into your clearing firm, and the CME will continue to take your exchange fees until you finally decide to say it's enough. So basically, if you're a scalper and you trade the micros, the CME is juicing you to eternity, and they're doing other things that if I said, my channel would get demonetized. So again, a lot of traders trade the micros because you can gain access to trade the NASDAQ futures in a product that tracks the NASDAQ futures exactly the same way. It's just 10 times smaller than the NQ. That's what we're looking at right here. And you can see the liquidity on the order book as well is just fantastic, of course. So the tick size of this market, as you guys know, is 50 cents, which is 10 times smaller than traditional NASDAQ futures, which are $5 a tick. Now, as we progress through this video, I'm going to describe to you why these micros are a ripoff if you do a lot of round turns. Let's go over to my little text document here, and we're going to be using some commission examples, and I'm going to be using the commissions from AMP Futures because their commissions are publicly displayed on the internet. And basically, if you have an account with AMP Futures, your commissions are going to be somewhere close to this for the micros, which is around an 88-cent round turn commission. And for the E-mini futures, you're going to be more around a $4 round turn. Now, didn't I just finish telling you that these products are supposed to be 10 times smaller in notional size than the big contract? That is true. In fact, they are. However, the commission you pay is not 10 times smaller, and this is where they're flawed. So for a scalper, doing business in these contracts is going to be a lot harder. How much harder? That's what I want to focus on right now in this video. So I've done a bit of math here and I want to show you the conclusions I've come up with, and I want you guys to make your own choices and your own decisions regarding this, and I want to hear your opinion about it also down in the comments section. So here we go with a couple of examples. Micro NASDAQ, the tick size is 50 cents and your round turn commission is 88 cents. Again, that's the commission you're going to pay if you have AMP futures as a broker. If you take a scratch, which means that you buy one and sell one at the same price, that's considered a scratch. You didn't make or lose any ticks. You simply lose your commission. If you took a 1 tick profit after commissions, your net profit would be minus 38 cents. If you took a 1 tick loss, your net profit would be minus $1.38. If we look at the micro S&Ps, they're very similar. Now, what I want you guys to focus on here is basically the skew between the 1 tick loss and the 1 tick profit. And what you can see here in this case is that this contract in particular is skewed more towards the negative side, meaning that a 1 tick profit in this case is still considered a loss after your commission. In the case of the S&P futures, a 1 tick profit is a slight profit, but this profit is still not even half of what your commission is on a round turn. The reason why we could expect a slightly negative skew in this case is because the NASDAQ moves more. So there's more opportunity for movement if you're trading NASDAQ versus trading S&P. There's also a lot more risk, so it goes both ways. Now, here's an example of the ZN. Look at the skew here between your 1 tick profit and your 1 tick loss. You can see that the skew is more balanced. That's how I could describe it to you. Now, let's go over and look at the ES and the NASDAQ futures, and we can see a similar thing here. In this case, the NQ with a tick size of $5 and a round turn of 4, a 1 tick profit is still profitable by $1. In the case of the ES, a 1 tick profit is profitable by $8.50, a little more than 2 times our commission. And again, like I described to you guys, if you have a broker that's willing to negotiate because you tell them you're a relatively high frequency scalper, they can negotiate this much lower and basically improving this skew in your favor even more. And this skew is going to be very important if you're a high frequency scalper. Nobody tells you this stuff. Here's some math I did also regarding some of my own trading as well. Like, this is actually statistics that is in my own trading that I've discovered after a while, and I'm sharing it with you guys here so that hopefully you guys don't make the same mistakes. So in the micro NASDAQ futures, you need to make a 4 tick profit to make 2 ticks after commissions. This will be important in our conclusion. So every time you enter and exit the market, you gave 2 ticks away in commissions. Let's say your expectancy is plus 2 ticks over 500 trades. Now, the formula for the expectancy is a very commonly used formula when it comes to any kind of betting activities. And it's basically the average win times your win rate minus your average loss times your loss rate. And if the expectancy is positive, it means that your expectancy is positive over infinite number of trades. Now, what we're going to look at here is the impact that your round turn commission has on your expectancy if you're trading the micro E-mini futures versus trading the E-mini futures, the big ones. Let's say your expectancy is $1 or 2 ticks in micro NASDAQ futures over the course of X amount of trades. I wrote 500 in this case, but it doesn't matter. After applying commissions, our expectancy now drops down to 12 cents. In this case, commissions made an 88% difference in our expectancy. This means that a trader who is a break-even trader will lose money by 88 cents per trade, and a trader who is profitable by 2 ticks on average will be a break-even trader. This is what can be understood as a rigged game, a game that traders are tempted to go for bigger profits to make up for their expensive trading costs. So again, this example shows us that if you are a break-even trader, if you trade the micros, you're a losing trader. And if you are a profitable trader by a small amount, in this case, 2 to 4 ticks, you are considered to be pretty much a break-even trader if you trade the micros. Now, this doesn't apply if you trade the minis, and let's keep going here. The higher your commission per tick, the more you're tempted to be greedy and go for bigger moves. If we had the same result trading NQ with a positive expectancy of 2 ticks, $10 in this case, we can subtract a round turn commission of $4 in this case, bringing our expectancy down to $6 per trade. In this case, the fees had a 40% impact on our expectancy. Now we need to understand this from a real life scenario. John is a scalper. Let's say John had a good run and he has traded micro NASDAQ 300 times with an overall expectancy of 4 ticks this time, $2 per trade. After factoring in the round turn commission of 88 cents, his expectancy will drop down to $1.12. In this case, it had a 44% impact on his expectancy. We can start to see that every time the profit expectancy doubles, the impact of trading fees gets cut in half. This is logical, but it's not sustainable in a real life scenario, making it a losing bet. Let's do the same example using the E-mini products. If John traded NQ 300 times with an overall expectancy of 4 ticks, now $20 per trade, after factoring in a round turn commission of $4, his expectancy will drop down to $16 per trade, with the fees having a 23.5% impact on his expectancy. To recap our data, we can see that in the micro NASDAQ, a trader who is profitable by 2 ticks on average is in fact a break-even trader, since their fees reduce their trading expectancy by 88%. A trader who on average makes 2 ticks in NQ is in fact profitable by $6 per trade, and the fees reduce their trading expectancy by 44%. There's different ways to word this, but I feel the simplest way was with this right here. This data tells us that it's at least 50% harder to be consistently profitable scalping E-micro products versus E-mini products. Now, the only reason I made this video for you guys is because I'm living proof of this. What this tells me is that scalping the micros with my current commission structure is not a winning strategy. So that's kind of where I'm at with that, guys. So there are competitors to the Chicago Mercantile Exchange. One of them is the Small Exchange. I'm sure you guys have heard of them. And basically the Small Exchange is offering you to trade similar products that are available on the Chicago, but at a much lower trading cost, in fact. But again, there are other issues there, like the fact that they're not really being widely traded yet. Let's just do a quick comparison and you'll see how if you were to scalp Small Exchange, your expectancy in trading would be greatly less impacted by your trading fees. So this is something very important if you're scalping. For example, I'll bring you over here for a second and let's look at micro WTI crude oil futures here. Your per side commission, if you have AMP futures as a broker, guys, is 69 cents per side. In this case, your round turn commission would be $1.38, which is larger than the 1 tick movement in your marketplace, which is again getting back to what I previously described to you, that you need more of a movement in the market to actually have a profit. If you were to go over to the Small Exchange and trade some of their products, what I can tell you is that their fees range somewhere between 20 and 30 cents, and it will depend on your broker, maybe even lower than that. So all of a sudden, let's say you traded their small US dollar futures, okay, that's the one all the way on the right side of my screen here. For every tick this thing moves up or down, you make or lose $1. Your round turn commission, like I just told you, let's say it's 29 cents, because I remember placing a trade on Interactive Brokers and the per side commission was 29 cents. That means your round turn would be 58 cents, which is only a little bit higher than half of the value of 1 tick. So in this case, scalping in this market would be much more favorable than scalping any of the CME Micro products. So that's all I wanted to describe to you guys in this video. I hope it was educational in some way. And if you want to learn more about anything I described to you, I'll place some links in the description. You can also check out the Small Exchange. I have some of their symbols listed right here. All right, take care. Bye. This is a scanner I created, and what it's doing right now is scanning for a correlation to the NQ, and look how fast it scans. It's going to scan over around, I believe, about 150 symbols. So I'm going to scan this, and all symbols that have over a 90% correlation to NQ over the parameters I selected are going to show up on the alert manager right there. So let me start to scan. It's starting to scan. You can see these are the ones that have popped up already here, and it's scanning over all kinds of symbols. So there we go, and it's done.